Hey, what's going on, everybody? This is Corey Smith with CMG Financial. We're here again for another Monday Mortgage Moment. Today, we're here to give you a little bit of information and talk to you a little bit about the differences of an FHA loan versus a conventional loan. If I can talk this today. But anyway, we're here to talk about a little bit of the differences. A lot of people are confused by, is FHA better for me? Is conventional better for me? And a lot of people know their situation better than, I have, because I haven't talked to you yet. So let's talk about some of the main differences of FHA versus conventional. Then you can kind of start doing a little bit of research, and then you can call me, and then we can get on the road to talking about which way is better for you. The main difference between an FHA and a conventional loan is that an FHA is a government-backed loan. A conventional loan is not. So what does that mean for you? What that means is that FHA is a little bit lenient, more lenient than a conventional loan is in regards to approving you for a home. Majority of the time, if you're just coming out of credit repair, you had some stumbles where you had some late pays, maybe a couple credit hits, derogatories, that type of thing, FHA is probably going to be your better bet. For those with kind of more cleaner credit, not perfect credit, but cleaner credit, nothing recent where they had any stumbles and late pays and that type of thing, the conventional could possibly be a better product for you as well. But just in looking at that, if you're looking at it from just simply a straight credit standpoint, 580 is the bare minimum that you can go to up to an FHA loan. That's what we allow. Now, if you want to qualify for any kind of first-time home buyer programs, down payment assistance programs, then we need to have you at a 620. And then obviously anything above that makes it even gravy on top. But that's the major difference between FHA and actual conventional. Now, let's talk about another difference. Another difference is what we call DTI. DTI is debt to income ratio, is what that stands for. When you're looking at FHA, again, FHA is a little bit more lenient on what they allow as far as the debt to income ratio. So let's look at an example. Let's just say that you're making $5,000 a month. If you're making $5,000 a month, FHA will allow you to go up to 57% for all your debts. Now, don't get confused. You have to include what's your proposed monthly payment for the house that you're buying and all the debts that you have. Student loans, personal loans, car loans, whatever it is that's classified on your actual credit report. Things like utilities and cell phone bills, things like that that are not reported to your credit report is not included in that actual calculation. So you're allowed to go up to 57%, which allows for you to qualify for more of a home. But now if you're going conventional, conventional for the most part is at 45%. Under certain circumstances, they would allow for you to go up to 50%. So you can see how that affects what kind of house that you can actually qualify for, because you're not allowed to use as much debt, which means that you can qualify for less of a home. But for some people, they don't want to kind of max out anyway for what they can qualify at 57%. They don't want to go that high anyway. So a conventional loan may be a better place for you to be. But we can talk about all that stuff later. Now, the next thing, credit scores. Another difference is credit scores. So kind of what I alluded to earlier, when you're looking at FHA, you can go all the way down to a 580. That's what CMG allows. FHA can actually go lower than that, but for us at CMG, we allow 580 and higher. For conventional, it's a 620 is your bare minimum credit score. So anything 620 and above, you actually have the opportunity to go conventional. The next thing is down payment. Everybody wants to know about down payment. So let's talk about the differences in down payment between FHA and conventional. If you're looking at FHA, your minimum down payment is going to be 3.5%. Not sure where a lot of people are getting this 20% down payment stuff from. I have no idea. But 3.5% is what the bare minimum that you have to put down for an FHA loan. Now, if you're going conventional, the bare minimum that you can put down is 5%. But this is the catch. There's actually programs that will allow for you to put 3% down. That's right, 3%, not 20%, 3% down going conventional. The 3% is more so catered towards first-time home buyers, and it's also catered towards low to middle income, households, so to speak. So there are special programs where they allow different things. They kind of allow different incentives and that type of thing for you to go conventional. Two different programs that I want you guys to jot down and take a look at. One program is called the Home Ready program. That is a conventional product that allows for you to put 3% down in order to get inside a home. The other program is Home Possible. Home Possible is another program that allows for 3% in order to 3% down in order to, for a conventional loan. Now, let's move on to the next difference between FHA and conventional. The next difference is student loans, the way student loans are viewed. Student loans is a major problem in America today because everybody has student loans. And student loans are going to affect what type of house you can qualify for. So let's just talk about FHA for a second. If you have a ton of student loans, regardless of the status of them, there's only two ways that we can actually look at those loans. One way is we take the total balance and we count 1% of your balance towards your monthly debt to income. Again, I don't care if you're in deferment, you're making no payments right now. Don't care if you're in income-driven repayment plan. We have to count 1% of the balance, or what we classify as a fully amortized payment. The status of your loan has to be in a fully amortized status where you're actually making fixed payments for a specific period of time. That's what a fully amortized payment is, a fixed payment for a specific period of time. So let's talk about an example. An example could be if you have $50,000 in student loans. Well, if you have $50,000 in student loans, we have to count $500 against your debt to income ratio. And chances are, if you probably went out and got that Benz that you was looking for, and your payment is $600 or $700, combined with your student loans, you might have a debt to income ratio problem. All right. Now, that is one way. That's the 1% rule if you have $50,000. Now, let's look at the other way. If you actually go and talk to your student loan people about getting into a fully amortized payment, your fully amortized payment could be $350 for the next 20 years. At the end of the 20 years, you would have your student loans paid off. That is a payment that we can use. FHA, there's only two ways that we can look at it. Again, we don't care about the status of it. Well, we do care about the status of it if you're in a fully amortized payment. But if you're in an income-driven plan or if you're in deferment altogether, we cannot use that payment. All right, now let's switch to conventional. If you have any issues as far as student loans and we switch to conventional, that income-driven payment that you have, if it's $10, if it's $0, whatever the case may be, we can use that payment. And then it doesn't count against you on your debt to income ratio. We can use that. We can use a fully amortized payment if you're in deferment. But we have to count a payment against you regardless. So just so you understand the differences of FHA versus conventional when it comes to student loans, so many people will come to me and they say, okay, well, look, hey, I'm not paying anything on my student loans. So I don't understand why I have a debt to income ratio problem. Well, you have to understand the guidelines that we have to follow in order to approve you for a home says that we have to count a payment against you. The only way we don't have to count a payment against you is if you're in an income-driven plan and your actual payment is $0. All right. Last thing that we're going to talk about is principal home. Well, it's called PMI. And what that is, essentially that is mortgage insurance. What mortgage insurance does, it protects the bank in the case that you default. So if anything happens and you default, the bank actually gets their money back. It secures the bank. It's the exact same as if you have car insurance. Something happens, the actual insurance company will pay for it. It doesn't come out of your pocket. Essentially, the principle of mortgage insurance is just about the same. Now let's talk about the differences. The difference of it is FHA, when you have the mortgage insurance, the preconceived notion is that the mortgage insurance is on there for the life of the loan, which in most cases is true. But just so you know, when you're looking at mortgage insurance, a monthly mortgage insurance, if you put down a 10% payment or more, your mortgage insurance will go away after 11 years. That's the one thing that most lenders don't even know to even tell you. Now, most people don't fit in that box where they can actually put down 10% or more. I get it. But at least you know that's an option in the case that you're selling a home and you're getting ready to get a big payday. Now you know, okay, well, look, if FHA is a better product for me, I can still put myself in a position where I can get rid of the mortgage insurance. All right. Now let's talk about conventional. Conventional mortgage insurance is pretty much based off of several different factors. It's based off your loan amount. It's also based off your credit score and some other different factors, so I won't go into detail about. But the main thing is, the lower your credit score is, the higher your mortgage insurance is going to be. Because the way the bank looks at it, you're more of a risk of defaulting on your actual loan. So essentially, there's no one size fits all when it comes to talking about FHA or conventional. There are lots of differences. Everybody's situation is different. The best thing for you to do is to give us a call and then let us take a look at the whole financial picture and then give you your options and tell you which product is better for you. Give me a call today, 832-297-7659. Let's talk about your loan and get you inside the house. Talk to you soon.